Hello, everyone. Welcome back to some of our returns guests, and welcome to Breakout Beauty UK's How to Break Out in 2026 series. For some of you who know me, I'm Sonia. I will be your moderator today, and I'm joined by Paul, our famous architect for our Breakout Beauty program. And we got two very special guests, which I will let Paul and the guests introduce themselves. But today we are talking about how to know if you're ready for investment and which type of money is actually right for you. So today we're here to help you understand exactly how to raise money for your company, what kind of money is available, and whether to go to the bank or an investor, and what you should be expecting along the way. Now, before we dive in, I want to just get through a couple of housekeeping things. We've got you guys for about 60 minutes, so we'll dedicate about 30 to 40 minutes to deep dive. So we're going to have a bit of a panel discussion amongst guests and Paul, and then we'll end about 20 to 15 minutes of the call today with a Q&A. So you don't have to wait until the end. I want everyone to put attention on the Q&A function below. You can start firing questions as we're speaking, and then we will tackle them towards the end. But feel free to start sharing as we go along. And I will be moderating myself and kind of tackle the ones that we think are most relevant. Just as a caveat, the session is being recorded and we will share the replay to everybody, so keep an eye on the inbox. And lastly, but not least, we will be sharing also a survey. You'll be receiving a pop-up that will take you about 2 minutes or less. And these surveys generally help us shape these webinars moving forward. And actually, this particular topic was created on the basis of feedback that we kept receiving. So we do read them and we do actually put any sessions that you guys want. So I think that's it for me. Housekeeping is all done. And I thought, Paul, I'll leave it to you. We can get into it.
Thanks, Sonia. I've just realised I've got my leak that looks like something from a horror movie right behind me. So if I start adjusting my camera to try and do that. Hi everyone, I'm Paul. I'm the director of Breakout Beauty and Breakout Wellness. I'm sure many of you are familiar with them, but if not, they're an accelerator program designed for founders like you to help you give you everything you need: the skills, the knowledge, the introductions, the know-how to scale your business into retail, to raise the right type of capital or investment, to raise your profile and help you through this journey that is a lonely, isolating, stressful lifestyle choice of being a founder. The applications for Breakout Beauty are open now. Sonia can put the link in the chat. If you're a founder, it's exceptionally good value. It's completely free to do. You'll transform your business over the next few weeks, for years to come. And we are just soft launching our wellness accelerator as well for people in the wellness space. This session is to try and confront head on a lot of the questions we get time and time again from beauty founders around: should I raise investment? Where can I get money? What type of money should I do? How do I raise money or get debt responsibly? And it's to try and confront all of the questions time and time again. And to that, I'm delighted to be joined by Nicole Scholar from HSBC Innovation Banking. Hi, Nicole. And
Hello.
Kira Byrne from Vestra Partners, which is an investment firm. Hey, Kira.
Hello.
Before I ask you both to introduce yourselves more formally, we also always have to do a caveat with these sessions that this is not investment advice or consultancy. This is aimed to try and give you a bit of understanding as to what to consider and what questions to ask yourself. Feedback here is well-intentioned to help upskill you on your knowledge, but it shouldn't be taken as literal advice. Capital changes your business. You need to go through it carefully, but hopefully the outcome of this session is that you know a bit more about what to expect. And with that in mind, Nicole, I'm going to start with you. Please introduce yourself. How did you get here metaphorically today, and what's your background been?
Yeah, no, happy to. Thanks for having me. Nicole Scola, I lead the consumer and health tech teams for the early stage bank of HSBC Innovation. So our bank is a specialty bank. We help founders that are on an investor-backed journey. So that's both through products, networking, and different solutions. So when you kind of launch in the UK, but then as you look to scale and grow globally or exit at some point, we have solutions and support for you at every stage. As well as people who are dedicated to the sector that they cover. So We all either come from a VC background or former founders in the space that we work with. I formerly ran a CVC for the largest healthcare system in New York, focusing on consumer and health tech investments and joint partnerships, and then ran strategy for a consumer health tech business after that. So thrilled to be here today. Really excited to get into the topics that we're chatting about.
Thanks, Nicole. Kira, same question.
Hi, everybody. My name is Kira Byrne. I am the founder of Vestor Partners, a growth-focused investment firm. We specialize in beauty and wellness and personal care in Europe. What makes us a bit different is that we don't just necessarily write checks and take a step back. We want to go deep inside the businesses we back, as will, genuine growth partners. So my background spans technology, media, fashion, and consumer. I was the vice president of new business innovation at Condé Nast, which is a global media company, where I ran an incubator building and running new businesses for brands like Vogue. And prior to that, I worked at Google. So that combination, I think, of data, brand, and consumer has given me quite a rounded lens of what makes a brand truly defensible versus what's just a good looking product. So then I moved into the investment world because I kept seeing the same thing, these brilliant founders with genuine products, answering a real problem, but failing. And not because the idea was wrong, but because they might not have built the right foundations before they went to scale. So that's really what drives everything that we do.
And it sounds a really silly question, but we get asked it all the time, particularly in the consumer space. Kira, why do brands or founders need external capital in the first place?
Well, I think beauty can be a capital hungry category depending on your distribution channels. So you can be dealing with long inventory cycles or upfront manufacturing costs and minimums, marketing spends that precedes your actual revenue. And if you're moving into retail, you can be waiting 60 to 90 days for payments while you've already spent that cash. So organic cash flow alone sometimes does not always pace with the beauty business's growth ambition. So I think it's but I think capital should really be looked as a tool, not a solution. I think a brand that uses well are ones that unlock a very specific growth lever, a retail expansion or an international expansion. So I think the brands that struggle are the ones who raise to figure it out. So capital kind of amplifies what is already there, both the good and the bad.
Yeah, 100%. And Nicole, we're going to be talking a little bit about debt, equity, working capital, growth capital, unit economics. So to put you completely on the spot, could you just give a very sort of top line summary of what the different terms are, just so that everyone listening to the next hour can understand what we're referring to?
Yeah, no, happy to. I think sometimes, especially coming from the US, debt is so heavily used over there, and it is in a good way also used over here in the UK, but sometimes can be underutilized when you're growing a business because you can worry about taking on too much that you can't pay back. But debt is essentially being able to borrow for your business. There's multiple ways that you can do that. The two kind of big bucket ways we look at it as an organization is term debt and then working capital solutions. Term debt it's almost like a mortgage, where you get one slug of debt that you can borrow and you pay it down over the course of time. And you can use that as runway extension, hiring key talent, investing in maybe new operations, whatever you need for kind of growth of the business. Whereas working capital, which Kara was talking about, is helping you navigate kind of the working capital cycle of the business. So looking at if you're a recurring revenue business, funding that cycle, or from an inventory-based business, helping pay off the inventory that you have in place. So working capital almost looks like kind of like a credit card where you get a line of credit, an amount you can borrow against that lets you draw down some cash to pay for additional inventory while you're still waiting to get paid back from customers. So there's a lot of different solutions that exist, and they can be used as, one mechanism of driving your business, but they can also be used alongside. And what we see quite frequently, especially from I would say pre-seed through Series B businesses, as we see this alongside equity coming into the business. So equity can come into your cap table and help drive growth. But investors are really, as was already mentioned, are giving you cash to drive to that next milestone. They're not really looking to invest in funding your current operations. They're trying to invest in what's going to unlock the next round of investment or large growth for the business. So bringing in debt or other working capital solutions to help with day-to-day operations, or what I jokingly call like side quest opportunities that would still be beneficial to the business, but weren't maybe on the plan when you were going to investors for cash, can help you kind of fund that cycle. So it's a great way to look at how your business is currently operating, get some support, not just using the cash you have, but borrowing cash from others, and then potentially bringing in investors alongside that.
And then finally, unit economics, because it's one I'm sure will come up.
Yeah. So do you want me to touch on that one?
Yeah.
So when you look at unit economics is interesting. So for when you're looking at a business in general, helping to get, I mean, for us, we're looking a lot at like the payback of investing, like when you spend cash out the door, when are you getting that cash back into you? So being able to leverage credit solutions, so primarily working capital solutions, can help you with funding inventory to get things into customers before it gets paid back to you. But you want to do it really at the most efficient rates. So being able to borrow from banks, you are borrowing cash, but it's really generally almost at the cheapest rate in market. So it can allow you to invest in the business and scale, but without having to spend a lot in other ways.
Thank you. And I think, Kira, one of the reflections we see time and time again is founders on their journey. Cash flow is always critical to make or break companies, but oftentimes they take on the wrong capital at the wrong time. And from your perspective, when is the right time or trigger or milestone when a founder should be thinking about taking on external capital, be it debts or loans, or looking for an investment raise?
I think there's probably three triggers or milestones that I'd be looking for, or that a founder could be looking at. One is on the revenue side, that you have a consistent growth in your revenue. That could be 100% year-on-year growth, or 15 to 20% month on month for three or more consecutive months. So that tells, I think, an investor that the growth is consistent, it's not a blip. I think on the retention side, what you should be looking for as a founder is, a strong repeat purchase rate in and around above 30%. So for D2C, for a D2C beauty brand, for example, 40% plus is where, a VC conversation really opens up. So it shows that the customers are coming back. It's that it's a proof and a reliability of the product love. It's not just marketing spend. And then I think the third one is the unit economics. So all these things like, LTV to CAC, so lifetime value to cost of customer acquisition cost. So if 3 to 1 is kind of a minimum, a gross margin on your product of about 70% or above. And you have a runway of about 6 months before you start raising. So, having all these figures in mind as you're growing your business ensures that when you go to raise, you're raising from a position of strength, not from desperation, because you want to be in that strong position, as strong as possible for your business to go into a negotiation position.
And Kira, why are unit economics so vital to look at in terms of the health check of the business from an investor's perspective?
Well, if you don't have, if I'm seeing, there's a huge revenue growth, but that there's all this amount of the margin is being spent on acquiring new customers, it's showing that you don't have that repeat, the potential for subscription. It's a different type of revenue. So it just means that it's less predictable. So having an understanding of the LTV to CAC, your AOV, all your margins from a gross profit, your landed COGS, all these things are really important, because that is what, makes a successful, scalable business. So you often see businesses, let's say, that are D2C first, and a part of their growth potential is into retail. But if you look at the gross margin, if it's 50%, that means you just don't have enough margin within your unit economics to be able to really scale in a retailer, who then they themselves will take maybe 45-55% of your margin. So it's just getting those foundations right. And if you find yourself in a position that you don't have, your hero SKU, let's say, is less than 50% margin, then you really need to review that, understand your pricing strategy and mechanisms, or then even build out product lines that have a higher margin so that you can off-weight that. But it's so important, because that is what kind of breaks a business.
And just to plug the Breakout Beauty Wellness programs, one of the areas we go in particularly is about unit economics, how to make sure you're able to have the right financing and health check in place so that you are sustainable and have it and able to grow. But also when it comes to retail as well, how do you develop the right margins to be able to afford getting into retail, because it game changes your business. I was going to, Kira, go on to fundraising quickly, but Nicole, I could see you sort of aggressively nodding and agreeing, and I wondered if you just had reflections on some things that Kira said. Or
no, I think just what Kira was saying in terms of like all those specific metrics are so important, and being able to tell the story as to why. We chat a lot about internally, like having and it's hard as a founder because you have to be kind of a specialist of everything, but then a generalist enough to be able to switch between things. But maybe finding, if you don't necessarily have a financial background, there's great platforms that you can hire fractional finance talent to just help you learn those metrics. And I'm also happy to share those. We have a good blog that breaks down the 5 or 6 metrics that Kira mentioned. But have someone help you track those, because what it should do is, if you're looking at metrics on that monthly basis, it'll tell you, are you spending cash efficiently? Is it coming back effectively? Are you creating really good stickiness with customers? And then it'll help you as a founder understand what levers you need to pull in the business to focus moving forward. So I think it's really helpful to focus on that, whether it's day 1 of the business or year 10 of the business. And if it's not something you've done before, there's great people you can hire for a couple hours a month that can walk you through kind of the numbers and give you support there.
And I guess same question I asked Kira a little while ago is, at what stage should a banking debt or institutional debt be relevant for a founder? What are the milestones by which they should or could be coming to a bank to try and get external capital?
So for us, it depends. If you're looking for, we traditionally come in when equity is in the business. So for us, when you're looking at venture debt, which is what we call term debt, that's driving primarily growth in the business, helping, you can use it for whatever, but it's to really drive growth, to invest in operations, to extend the runway of the business another 3 to 9 months alongside equity. We would look at really a Series A kind of fundraise around the £5 million mark to access that kind of debt. And we would do anywhere from, depending on the type of business, 20 to 30% of your recent fundraise in additional capital on top of that. The great thing is it's non-dilutive, so it doesn't affect your cap table. You can invest in the business as you see fit. So it's great for investors because it's more cash into the business. It kind of de-risks their investment because it gives you more firepower to work with. And then for working capital, it's about the same threshold, not necessarily on the equity side, but more so where you're trading. We do have a couple solutions though, and I would say for any inventory-based business, whether you work with us or another bank, asking your banker about trade finance solutions. So I think a really good one when we talk about working capital is it's the delta between when you have to pay someone and when you're getting paid back from your customers, is that working capital gap. And you don't really want to use investor cash or your own cash to bridge that gap if there's other solutions. So if you talk to banks, we can do things called manufacturing guarantees or trade finance guarantees, where we will help you renegotiate your payment terms with your manufacturers. So if you can extend that payment cycle, it may get you closer to when you're getting paid back from customers and start to bridge that gap. That's something that we will do, or banks will do without equity on the table. So that's something you can start from a very early stage business. They'll talk through the nuances of like cash security and things like that, but it's a very effective mechanism to help with working capital for a very reduced price. And then traditional commercial banks outside of like HSBC will do business loans, for early stage businesses for 20 to 50 grand. So that's always something if you're getting started and need just a bit of cash in the door that you're not looking for it to be capitally dilutive, you can do that as well.
I think just for all the founders out there are grants available. They're not necessarily free cash. They're not necessarily easy to get, but do your research in terms of what government grants, what support's available, what innovation grants are available. It is a bit of a Google bashing game in order to find the right ones, the right eligibility. The days of grants being easy to get are long gone. They are fiercely competitive, so you possibly need to get help to write those grants as well. But if you are a traditionally minoritized founder, if you're a female founder, if you're a founder of color, there's often specific grants available for you as well. I think there's more availability in technology than there are in consumer products, but it's worth having a look. And everyone should also be looking at R&D tax credits as well. If you've invested time and money to be building new IP in the business, oftentimes there's a very legitimate way of reclaiming some of that money back from the tax man. So it's worth having a look into. Keep those questions coming as well. Kira, we've talked about investment a little bit and fundraising. I guess it's not as easy as going to someone like you asking for a check because you like the founder and the product and walking away. What's the usual process, I guess, of a fundraise from a founder's perspective?
Well, I think that, the way I would think about fundraising is it's not the starting line. It's a reward for having already built something real. Certainly in the stage that I'm at, which is the seed stage. So in fundraising, we've got, if you've pre-seed, which is when you're just maybe up and running, you have an idea, a little bit of revenue, then seed is when you have a little bit more coming through and you've a bit more of a promise, I guess, and then the Series A when you really have the business up and running and you're looking to scale. So I think from our side, it's really looking at three, as a founder, the way I would think about it, and this is the way I when I was looking for investment, when I ran this incubator, Condé Nast, I was looking always at these three things. Which was desirability. When you're building a product, desirability, does the market actually want this? Have you proven that consumers want it and they'll come back for it? Viability, can you make money from it? Do you have the unit economics, the margin, the gross margin, all of that built in? And then feasibility, which is, can you build it with what you have? Is it actually feasible to build? So I think coming to think about fundraising is like, have you answered honestly all those three different quadrants? And I think when it comes to fundraising, you should be looking at using that capital for very specific things, specific milestones, unlocking activities with like a clear return. So let's say we're going to raise 500,000 to expand into retail, or we're going to use those funds in a very specific way. It's not just for growth. Like, it shouldn't be used for plugging operational holes or funding a strategy that you haven't proven out yet. So I think being very specific about what that capital is being used for.
I'm completely stealing that. Viability, feasibility.
It's the design thinking method of It's quite an old. There's a book, if anyone is interested, it's called Change by Design. It's brilliant. And it's basically how you develop products using as little time and resources as possible. And you're always doing these different experiments to work out if you can answer those three different quadrants.
And I can dig it out and send it around. I've got a couple of slides and frameworks from seed to Series A on your levels of product market fit and how you can try and claim indicators of product market fit based on the desirability of where you are. I'll try and dig this out and send them to people. Nicole, I think when it comes to debt, I think different founders have got quite different relationships to debt and taking on what's perceived as loans. And again, we see people taking on debt or taking on the wrong investment early on in the business, and it hasn't been the right decision. How do founders navigate taking on debt responsibly and at the right time?
Yeah, no, it's a great question. And it's a hard one, right? Because you also have to make the personal decision of, what are you comfortable with? Where we get involved is more so once the business has some proven scalability and has investors on a cap table. So investors are helping somewhat de-risk it in a way because they're bringing cash into the business. They've taken a good, strong look and seen that there's going to be hopefully a pathway to ROI for the business in the near future. So that's helpful for us. I think for early stage businesses though, finding ways to, I think like the trade financing solutions are really helpful. Try to find ways to minimize taking, on as much debt as possible, but finding more creative ways of can you get paid back faster from your customers and pay your manufacturers a bit longer. I think that's really helpful. But then also when you're talking to a bank, they're going to go through a credit risk profile anyway. So they're going to look at if you're taking on personal debt or if you're taking on business debt, they're going to look at the structure of the business and they will have what we call like leverage ratios, essentially how much we're willing to give you for credit versus where the business scale currently is. So I think just having active conversations, like having a good understanding of what interest rates you're agreeing to, what is the repayment cycle on that debt. And if it's something that's new to you, I think the best case is always hire someone for a couple hours a month. You can, this isn't sponsored. I don't work with them professionally in any way, but like Upwork or TopTal will have really good fractional people that do this outside of their normal jobs or do it full time, but in fractional ways. Hire someone that can walk through a P&L with you and through your balance sheet and show what the impact of debt will be, both in driving business growth, but also what it could mean if you spend that money and it doesn't come back into the business and what that repayment can look like. So I think just ask a lot of questions and tier up slowly over the course of time.
I think build relationships with your bank as well. I think
Absolutely.
be it HSBC Innovation Banking or others, I think some of the more traditional incumbent banks actually have a suite of services available and relationship managers to help people like you. I think some of the neobanks maybe don't have that suite as yet. But speak to them early. And Kira, you are renowned for telling founders not to raise. I'm overly simplifying, but I always find it extraordinary when we're in conversations and you're telling founders to not raise yet or not raise and don't give away your money, which feels counterintuitive for someone in the investment world. What do you mean by that?
Well, I guess what I'm really saying to the founders is, are you in the best position of strength that you can possibly be in? So, look at the foundations of your business first, and then be able to answer key elements. And the way I always break that down is into three different sections. One is brand and audience. Can you define and articulate your brand messaging and identity? Look at your consumer reviews. Is what people find interesting and important and useful, how you actually describe who you are. And it might be clear to you, but is it actually clear to your consumer? And does the identity, your visual identity, align to your brand messaging? The second is defining your customer with precision. Saying we target women 25 to 45 is not tight enough. You want to understand demographics, their behavior, how they shop, where they shop, why they shop, really getting kind of the psychographics of your customer. And then the third one on the brand and audience piece, which is building a community, not just a customer base. And this is one of those things I ask all the time. Like, have you got your email list set up? If you're working Klaviyo, are they super tight? Have you loyalty programs? Can you build a subscription program in place that can really help drive your returns? Those types of revenues are incredibly valuable when you go to raise. The second area then is product. Have you a clear hero SKU? It's really important to have one hero SKU, I think, that can pull you through the months that are a little bit tricky. And it's a way of getting, you can easily market your product to consumers and bring them into your world and then show them the other products that are aligned to maybe their problems. Have you evidence of product market fit, repeat purchase, customer reviews? Have you mapped your product roadmap to customer pain points, understanding your COGS and unit economics? And I think also, have you product defensibility? What is it about your product that is different? From a formula perspective, so really understanding the defensibility of it. And then the third category is operations, knowing all your unit economics, your landed COGS, fulfillment costs, building systems that don't depend on you personally. I think this is one thing I see a lot of founders going, I can't take holidays because there's nobody there to take over XYZ. But I think this is where, putting in a system in place that can, not that I don't work with them, but, a product like Gorgeous that you can have on your website that can answer initial customer questions can be an extremely helpful way of freeing up some of your time. And actually, if people take anything, is like, leverage the AI tools. Is kind of I ask founders all the time, are you using AI tools? And a lot of them don't. So something like Claude Cowork can be incredibly helpful tool for you to have within your business. And then finally, on the operations piece, is like showing that operational scalability. Can you 3x your volume without 3xing your costs? And this comes back to the retention of your consumer. So I think if you can answer the questions and that foundation is strong, then I think you should consider raising, but being really conscious of the kind of the math, I guess, which can be challenging. If you have an inflated valuation, for example, before your revenue justifies it, you're essentially borrowing against a growth you haven't proven yet. So it's quite a big risk. So I think just getting all those foundations right, bringing capital too early can just paper over a problem that should have been fixed. You sometimes see founders raise using the capital to mask poor unit economics or weak retention or a team that isn't working. The money will run out and then the problems are still there. So you really want to sort out the foundations so that you're in the best possible position of strength in order to then go out and actually raise.
And you want to raise, I think there's always a power dynamic.
You don't raise necessarily. It's just make sure that you're in the right position for yourself to raise.
And I think there is always a power dynamic as well. If you've got healthy margins, healthy unit economics, if you've got that really defined growth strategy and your business is defensible, when it comes to negotiating with retailers, negotiating with investors, you get better terms ultimately. And it's a challenge for every founder because they need money in order to get there, but they can't get there without the money. It's not easy.
But I think back to the discussion, the amount of people who I meet that don't use working capital or debt because it's a bit kind of scary. So I think really understanding how you can leverage that for your business is really powerful to get you to that point, fixing all the foundations, be able to scale within the parameters that you're operating in before you take on capital. And even asking an AI tool to just educate you on debt and working capital, go, this is my P&L. Where could I leverage some different types of capital before raising? It can be very powerful.
If you could get all founders, it sounded like you've just answered that, Kira. If you could get all founders to do just one thing to help them financially, what would that one bit of advice be?
Beyond like just leveraging non-equity based financing like debt and working capital, I think it's really that. It's just ensuring that your foundations are as strong as possible, understanding your numbers, and then seeing how you can bring capital into your business without giving any of your business away. Sometimes you see, I was speaking to a founder recently, they were their seed and they had given 30% of their company away. It's a huge amount at such an early stage. For honestly, the value that person brought wasn't great. They haven't really been able to support the founder at all. So that's, and then that's really hard for an investor coming on. If you don't have a good portion of your business by the time you get from pre-seed to seed to Series A, it's going to be very hard for an investor to come in. Because you're going to you won't own all of this effort you're pumping into your business. You won't own enough of your business.
Yeah. I think it's easy to give away too much too soon, and the types of money and types of people and expertise you need at different stages of your business changes considerably. We've seen people give away advisory shares early on, quite substantial, to the people that they probably wouldn't need in a year's time.
Yeah.
Nicole, same question. If you could advise founders to do one thing to help themselves with their business growth, what would that be?
Yeah, I think similar is like just know your numbers, have a really good understanding of what the business is currently doing from a metrics perspective and what that means. Does it mean you're investing well? Does it mean it like in the right marketing channels? Does it mean that your inventory is coming in, you're paying for it in a good time frame? And then leverage resources. So like I think Paul mentioned before, like banks are specialists in this space. Your relationship manager, most of my job, I jokingly say, is two things. It's one being like a free outsourced chief of staff to my founders. So when they have questions on financing or growth or networking, or hey, you've seen, 50 companies this year come through your door, like who did things really well, ask your banks for suggestions and connections. A lot of them, I mean, we host sector and life stage specific events probably almost every month that digs into topics like this. So ask them and ask them for what tools and resources can help if you're struggling with inventory or hiring or rents for lease spaces and things like that. Your bank will be able to help. And then if you also don't have the internal um, capacity or you don't have the background in some of the topics, like certainly leverage AI. IVEE is a great company. They help companies upskill with AI and they do a ton of free like trainings online. So that's a great place to start. I think they have an AI school just for like AI 101. So that's a great place to start. And hire fractionally. Like it's probably worth hiring someone for a couple hours every month just to look through your books and see how things are going and growing. And then they can frame those conversations of should we invest or should we get investment? Should we scale with banking solutions and things like that? One thing we didn't, I know we're going to move to Q&A. One thing we didn't talk about though I think would probably just be worth mentioning is exploring SEIS and EIS investment if you're going to go through the investment process. So that is a really great tax incentive for investors to go invest in riskier early stage businesses. It's mostly based on early stage. Investors will get anywhere from 30 to 50% of their allocation onto your cap table, up to a certain threshold, based on how much they're putting into the cap table. So it's a great way, and it's a pretty simple process for someone to get that kind of tax accreditation. So if you are looking to get investors onto the cap table, especially early stage, there are angel syndicates that help focus on getting interesting businesses to get fundraised with investors that are focusing on that kind of investment. It's an amazing program the UK has. It's not something that the US has. So certainly something to look at, whether you're just asking friends or family, it's something they can benefit from as well. So just wanted to also make a note about that.
Great point. Thank you very much, Nicole. Thank you very much, Kira. Sonia, I can see a lot of questions jumping up.
Yes, and actually, I was just going through some of the questions. I feel like you've all covered a lot. So bear with me if anything feels repetitive. I think maybe the audience just wants to kind of recap on a few things. But I particularly like this one that I thought we could get started with, and it's a question for the both of you. So we can start with Nicole. When a beauty founder walks into the room, what's the one thing in the first 10 minutes that tells you they're not actually ready to raise? What's your first initial thought?
So I'm assuming we're saying funding, right?
Yeah.
Versus
Yeah,
investment
so
versus debt.
exactly.
I would say, I think we've chatted about it a couple of times, like someone who doesn't know their numbers and who probably doesn't have good traction in market. Investors, I joke about it, I'm a big analogy person. But an investor is almost like a mom talking to a teenager who wants to go out late in high school. It's like, well, where are you going? Who are you with? What are you going to be doing? It's like be able to answer all the questions of if I give you this, if someone's to give you this cash, what is it driving? Investors want to be investing into growth. So you really need, if a founder doesn't know their story, what that quantum of cash is going to get them and what the return to the business is going to be, then I would say they're probably not ready for investment yet.
Fair. And Kier, what about you? I imagine the red flags on your end are slightly different to what Nicole might be.
Yeah, I think like so just to clarify, you'd have your debt and working capital, and then when you start to give away parts of your company. And that's
Mm.
when you might do like friends and family rounds or like a pre-seed round where you have an idea, you might have a little bit of revenue, but probably not. It's just an idea and a dream, and you found a problem or you found a product that you think was going to solve a problem. And then you move to seed when you have a certain amount of traction revenue wise. While we specifically for our team, we're looking for businesses that are between 1 to 3 million annual revenue. So they're probably 2 to 3 years old. They probably have, 1 or 2 channels working very well. They probably have one hero SKU and perhaps 2 or 3 other products. So there's kind of a general profile. But you can still raise capital from family, friends, and pre-seed from angel investors. And there's groups in the UK that are specific. There's a lot, as Paul mentioned, for female founders as well. Like Alma Angels are just a team that I know. There's a lot more. So I think when it comes to me, it's really like, have you proven out that your product is solving a problem? Do customers love it? Are they coming back to buy it? Is your unit economics working out? Can you actually scale with how you've developed this product? Is it defensible? Can you describe why it is defensible, as opposed to just a great branding? What actually is it that's going to allow for longevity? So I think it's probably those. It's the product and the operations piece.
If you've got Kira, if you've got indicators, if you've got indicators of product market fit, you've got a product that has got traction, but the unit economics aren't right, or you need investment to have better negotiation powers with your manufacturers or packaging companies, where often capital can help that. Is that a conversation worth having with an investor, or do you want to see them once they've figured out some of those problems?
Yeah, like I'll give you 2 examples. There was a fragrance company I spoke to recently, and the way they've developed the product means they literally cannot shave off any more margin. But as we were talking about like, how can you build, if that's going to be your hero, how can you build products around it that allows you to bring people into your brand and you have a far higher margin? Like that's the way most consumer businesses are. Like you look at like the fashion world, the margins come from accessories and from beauty, not necessarily from ready to wear, but the ready to wear is what puts you on the map often. So it's like kind of having that product fit, but you're probably very early to be thinking that really if you have such a gross margin problem, really investigate your manufacturer. There's always other manufacturers that you can go to. And so I have a brand I'm thinking of right now, and they have been producing in one location. They are now changing the production to another location within Europe, and it's going to cost them it's going to be about 60% less. So you just got to do the shop around, and that's where these big events really help, the manufacturing, the supplier events, the packaging events, because you can find some really great people there.
There's one point to that, just there's sometimes government bodies as well, like there's IDA, the Irish Delegation Authority, does help also with shopping around early stage businesses to different manufacturers and helping find competitive pricing, because they're looking to bring more jobs to different parts of the country. So also just look at different government bodies that may be able to help support you on that journey.
Hmm. And I guess with all this in mind, somebody's asking now if you could give a concrete example of where debt would be a smarter move over equity, and the other way around too as well. If you could give just that, I guess, yeah, that visualization to them. Kira, if you want to start.
Sorry, what's the difference between debt and
Yeah, if you can give an example where debt would be a smarter move over equity.
So I have one founder so I'll just give you an example. She has about 80% of her revenues through wholesale, and she really wants to build D2C. So, but the D2C is unproven. She hasn't got the brand hierarchy, the messaging. She hasn't got the cut through yet, and she still has a lot of work around that. So, as opposed to raising money to explore that, she can just use the revenue she already is getting in and just secure a little bit more off like debt from that. Um, I think generally, always look at debt and working capital before you take on any equity-based financing. That's just my feeling, is that you can control that if you understand your P&L and you understand your finances and your unit economics. You can control that a lot more than you can bringing externals into your business. So that'd be just my perspective. I'm sure people would disagree, but that's what I would say to a founder.
Kira, nobody should ever disagree with you.
No, but everyone has such different experiences. Like, and I'm sure another person in the same space as myself might say something very different. So this is just based off the experience with all the founders that I speak with regularly.
And very, very random one. You watch, Dragon's Den or Shark Tank, and obviously, it's a very creative, unrealistic sort of pitching process. But oftentimes there will be the sort of moment of jeopardy where the founder reveals that they've actually got, a 50k loan, a 100k loan. There's debt in the business, and you see everybody's face fall. From an investor perspective, how what's the word I'm looking for? When you see debt in a business or working capital debt, is that a red flag for you in a business, or is that a positive, or does it not matter or influence your investment decision at all?
Look, it's a consideration, but as long as it's managed well and the terms of the debt, like there was one person I saw recently, they had a horrific debt term. I don't know how they got it, and I didn't actually know the provider. So that with that you'd have to refinance that debt. But generally, most of the bigger players or your banks, they're going to have fairly standardized terms. So to me, I like to see it. I like to see that lever has been pulled. Obviously, with like a reasonable amount. If someone's coming in with 150,000 of revenue, 500,000 of debt, that's a problem, I think. So to me, it certainly isn't a red flag as long as it's structured well.
I was wondering if I could direct to Nicole now that same question around when is an example where debt would have been a smarter move over equity? Curious to see what you think, or if you disagree with Kira, maybe.
No, as Paul said, no one disagrees. I very much agree with what she's saying, especially in the consumer and wellness, unless it's like a device, like an Aura ring or something where there's a bit more tech involved. We're seeing a big shift versus in other sectors where historically you would just kind of go in and fundraise pre-seed, seed, Series A, continue. We're seeing a lot more on the consumer and beauty side raise like a pre-seed or seed, and doing what's called seed strapping, where you take 1 or 2 rounds of early investment to develop those, the first product and get some stickiness with customers, and then really drive to profitability. And then that's what Kira's saying is like, take your excess cash flow and reinvest in the business and grow that way. So you maintain as much ownership of the business with the goal of probably being acquired in the next 5 to 7 years, or staying a large kind of corporate entity. But debt's a wonderful way of, I would always look at like any kind of inventory financing. So investors want to invest in growth. They don't want to invest in current operations. And by current operations, we mean inventory. So when you're looking at like, or if you have a recurring revenue business, they don't want to invest in your existing revenue cycle there. They want to invest in hiring key talent, or opening up a new country or region, or expanding to a product that has proven traction that's going to expand, your product suite, things like that. So when you're looking at, I have more customers and I need to have more product to sell to those customers, you've already proven that they want the product and everything, that's when debt should be leveraged. And you can use that certainly through banks, depending on kind of where you're at scale wise, or there will be third party lenders like a cap on tap, a 365 finance. I know Shopify does their own. I would just say if you're not leveraging a bank, and the specialty they have there, and the relationship managers and the bankers that will walk you through what those terms mean. Again, go have someone that is, very financially proficient walk you through what those terms can be. Because similar to Kira, sometimes we see early stage founders that took on what they thought was great debt that just have very balloon payments, and fees associated that they never knew would exist. So just make sure you understand the total amount. But yeah, I think it's use it for inventory and for existing kind of operations of the business, and then use investment. If you're going to take on investment, use that to drive key growth.
Be kind to your future self as well. I think whenever we have people going through rounds of investment, we always say, what does this mean for your next round and the subsequent round? Because like Kira's example, we've seen so many great startups that have got traction, have got a good thriving potential business, but they don't have enough equity to give away to get the Series A, Series B, and they get that.
And to that, Paul, like I think, and Kira, correct me if you feel differently, kind of the North Star we look at is like at most per round. So like pre-seed, seed, Series A onwards, you should give up 10 to 20% of your cap table. And remember, you're giving up probably an additional 5 to 10% also when it comes to like your employee stock options and things like that. So you don't want to sell too quickly, because one, it doesn't let other investors get into the cap table and own majority in the future, which Kira's mentioned a few times. But two, you don't also want to get to a Series A and have 10 or 20% of your cap table, and your investors will say, are they really still motivated to make the personal sacrifices of this business if they own so little of what the exit will be? So you want to kind of, that's what we look at generally when it goes round for round, and then know what terms you're negotiating as well. So always bring in, legal talent that can make sure they're giving you good protections to make sure that at each round you have the right investors pulling the right terms in for you.
Great. Well, first of all, I'm wary of time, but I'm wondering if we can sneak one last question. And I did have someone come in with something interesting. I know that we spoke about what are the one thing that every founder should do, but I guess I want to switch to what should be the first thing a founder should do. Let's say you're a first-time founder. What do you tell them first thing you need to focus on before anything else? Kira, if you want to start.
What would I tell them? I asked a very, very successful founder this question myself about a month ago. And that person has had a very big exit, and they're on their second business. And I just asked, like, what do you think is the thing? And they said, once you have the product nailed, once you have your defensibility piece, you have to flip your mindset to become a marketing company. And that's where you have to be so clear on, like, what is your brand saying? What do you stand for? Visually, what are you saying? What's the packaging? Does everything align? Somebody mentioned about customer, how do you understand your customer? It's called customer profiling. Really understand, and just Google it, and there's loads of ways of learning how to do it. Who are who are they? How do they buy? Do they have kids? What's their purchasing intents? And really building all that, like ensuring that all aligns back to your brand, and therefore you can market. And if you haven't got that, you're going to spend so much time and effort and money marketing in the wrong places, just fishing in the wrong ponds. So that was his response back. But I think now what I would also say to every single person I meet, I am saying, are you leveraging AI? Because, when I see somebody go, we want to raise 500 grand and 250,000 is that going to go on staff? I'm like, is it really though? Are you using, just in my experience, again, this is only me, but I use Claude Cowork a lot. And it is a place that you can like input all your Shopify data, your analytics. You can ask your questions like, how do I prevent having a leaky bucket? How can I improve retention? And all of a sudden they're like, a marketing analyst in your team looking at all your data all the time. So I think just leveraging the tools that are out there, so you can free up your time and just make the most of the time that you have. So you're not having to bring in more people, which affects your focus to hire them and then manage them. And using fractional teams is so powerful as well. That's, and I think that someone was asking about how you actually determine who is good or not really. And using a network, like speaking to other founders, is so powerful. So sorry, that wasn't a very straightforward answer, because I already answered it initially, which is just focus on foundations. But I think that point of like, once you got the product, that your product is defensible and beyond reproach, how do you become a marketing company?
Nice. And I appreciate you caught on also what people were saying about the profiles. But Nicole, oh yeah,
can I
go for it. Yeah,
reflect? We were working with a startup recently who had 5 million turnover, but 80% of that was from one online channel. And I think, because it is a lot easier these days than it used to be to start selling on TikTok Shop, on Amazon, they're not easy necessarily, but they had built a great business, but they'd realized that they were so dependent on one channel. And I think what we'd always say is alleviate your dependencies, because if an algorithm changes or someone leaves, and that, completely, I can't remember the word I'm trying to look for, destabilizes your business.
Yeah.
You can't.
I think like sometimes you see founders that are maybe 500,000 revenue and they're across 6 different channels. And I think that is really hard. So focus like within the chapter that you're in, focus on nailing TikTok Shop. But when you get to a certain point and you are as overexposed in one channel, then you have to build out a second channel. But I think the focus is the biggest, like what is the thing that is going to be the most meaningful step for your business in this chapter, and recognize the fact that the next chapter is going to be completely different tools, different channels, maybe different resources and people, but being super focused and not spreading yourself too thin for the chapter that you're in. If that makes sense.
And don't raise.
Well, if your foundations are right, I don't know. Look, that's just my perspective. But if your foundations are right, go for it. Have at it. It's just, if they're not there, you're not going to be able to raise off great terms. You're going to have a lot of conversations, and again, your focus will be lost. You won't be doing the thing that you're meant to be doing, which is building your business.
100% agree. Nicole.
Yeah, no, I think probably echoing similar. I think the first thing is like what we always say is people buy from people. So in 2 ways. One, your customer wants to buy from you. So if you don't have, especially in the beauty consumer wellness space, if you don't have a digital presence, you need to. People love founder-led content and they want to buy from someone with a story and a mission. I think like Salt is a fantastic example of a business that's super lean, does not spend a ton when it comes to ad spend, and they're very open about that, but has really created a community which then drives towards like it's less expensive for them to acquire customers, they get better returns, they have higher stickiness, and it leads to everything that you want from a metrics perspective. But then also, if you decide to take on investment from the other side of it, people are investing in people. And so you need to be really, really tight on the story of why are you building this business? Why are you best to be building this business? And why are you going to get out of bed every morning for the next 5 to 10 years and be really excited about, the stressful things that you have to manage to get there? And then I would say the other piece, which is especially in the consumer and wellness space, you're generally building towards an exit. So primarily being acquired, but if you want to stay standalone, absolutely, there's much more pathways to that these days than there were historically. But if you are building to get acquired, build for that. I think Runna and Strava is a really great example of identifying a niche that wasn't there and building that community and building their actual product to make it so that they were a very easy acquisition when they were ready to be acquired. So as you're thinking of as you're thinking of your business, making sure you have an individual, unique product and service that someone does want to acquire because it's going to tuck in for something that they're missing, and it makes the story so much better. So not just looking at, I want to sell the business in 5 years, but how am I making myself very, very sellable in that way where it will make that process the best valuation with the smoothest transition.
One of my favorite examples, I forget her name, was the founder of Spanx.
Yes.
And when she was building business,
Sarah Blakely.
that's right. She bootstrapped the entire business because she wasn't aware of the whole world of being able to get investment. So she created a multi-billion-dollar business. When she exited, I think she owned 100% of it and joys. Sonia, I'm just conscious of time.
Yeah, no, I think that's actually the perfect way to close it. Well, first of all, I want to say a massive thank you to you, Kira and Nicole. I really appreciate it. Just the amount of information I think we provided everyone, and there was no sugarcoating, which I think is what we love to see. And I think, founders need to hear things that they probably feel it too, and they need to hear it. So I really appreciate this talk. A couple of things on my end might sound repetitive, but I want to make sure everybody's aware. The recording of today's session will be shared with everybody. So if there's any bits that you want to save or want to revisit, you will have it in your inbox. I've also dropped a couple links, so follow us on socials. I've also sent our email in case you have other questions you want to ask us. Drop us a message in any channel. We'll get back to you. And then, of course, I can't end this webinar by saying that our Breakout Beauty applications are open. I've sent the link, and I hope that whoever joined us today, founders, do apply. And I think today was just a bit of a sneak peek of kind of the things you could learn from, even more than what we've done today. And again, lastly, please take a minute to do the survey. If you want more episodes like this, tell us what you want, and we can get people over to do it. And then even the last thing, we do have another webinar coming up, which I'm going to send the link now. That one's more of an Ask Me Anything for applications are closing on the 15th of June. So they're coming up. So if any of you are in the middle of doing an application and got some questions, join us on the 11th of June with questions that you've got. Paul will be there to answer questions. And we've also got guests from our last year cohort to give you another deet.
And to dangle a carrot, if you want to see Kira and Nicole again, they're both involved in the Breakout Beauty programs and Breakout Wellness programs. So for that alone, you should apply.
Yeah, exactly.
Well, Sonia, thank you so much for your time. Thank you, everybody, and see you soon.
Thanks for having us.
Thank you,
everyone. Enjoy your lunch. Bye.
Bye.